Hey traders, Akil Stokes here with Tier1Trading.com. Hope you had a great week and I hope you're excited for another weekend edition of The Trading Edge. I'm excited because today we're going to talk about a topic that has been making its way around the internet, around social media, and generating a little bit of debate. And that topic is, what skill of trading is more important? The skill of making directional predictions, accurate directional predictions, I guess I should say, or finding the entry reason. And as you guys know, we've been hosting a 2-week workshop called EMERGENCE. We just wrapped up this morning. And something that I love that we get to do in those type of workshops is we get to kind of work with traders who are brand new to our style. So traders that are out there kind of misunderstanding what trading is, maybe they get sucked into a lot of the internet junk of trading has to be this, trading has to be that, or even the worst stuff out there about the get rich quick stuff. And we get a chance to really reprogram them and teach them about what trading really is. And that is, trading is a business and it needs to be treated like such. And any successful business has a process, and any successful business has a process that is consistently followed. It has a formula to success, or formula for success, I guess you can say. And the formula to success in trading is consistent analysis plus consistent execution equals consistent results. And in order to have consistent analysis, there needs to be a consistent process. And the process that we teach is called IPDE. Identify, predict, decide, execute. You want to identify what price is doing. That's the analysis, or first part of the analysis. You want to predict, right? Based on what you identify, what direction you think price is likely to go in next. After you make that prediction, you want to decide, right, how you can get involved, or if you can get involved. And then finally, you want to execute the trade. That's the whole trading psychology part, where you actually have to do things the right way, right? Enter when you're supposed to enter. And understanding this process, right, and understanding that trading is about following this process instead of just finding the magic strategy or the magic entry signal is very important, because this process is built out to stop you from making mistakes. And one of the conversations that we had over and over again this week was trying to really pound into the newer trader's head that, hey, the entry is sexy, the trading strategy is sexy, but the part that really matters the most in trading is your ability to analyze a price chart, your ability to take your analysis and make predictions off of it. Because if you can't make those predictions, how can you do anything else? So when I put the poll out there about what's the more important skill, making accurate directional predictions or the entry reason, however I termed it, I already knew the answer. I knew which is more important. I also kind of knew what social media would give me as far as the percentages, just because most people on social media have the wrong idea about trading. And you can see the results came back about 60-40, a little bit higher than 60-40, right? With entry reasons being the most important, really standing out. So about 60-something% of people, and this is polls across multiple platforms, I'll just share with you one screenshot, but 60+% of the traders out there thought that the entry reason was the most important skill to have, while only 40 or sub 40 thought that it was the accuracy of the prediction. And like always, or like most of the time, right, the majority is wrong when it comes to this, right? The correct answer is the prediction, the prediction, the prediction. Now, don't get me wrong, right? I'm not saying that the entry reason isn't important. I'm not trying to say one is important, one's not important. But if we're grading the two on which is more important, it has to be the directional prediction. And I say that because the entry reason is irrelevant without the directional prediction. So going back to that process I just walked you through, IPDE, identify, predict, decide, execute. What we're doing in the first half of that process, identify and predict, is we're analyzing the price chart, we're making predictions, we're trying to figure out what side of the market we want to be on. Do we want to be bullish? Do we want to be bearish? Do we want to be continuation? Do we want to be counter trend? If once we decide what side of the market we want to be on, we want to ask ourselves the question, okay, is there room for opportunity? If I want to be long, where do I want to be long until? If I want to be short, where do I want to be short until? If I want to get short, where do I want to get short at? If I want to get long, where do I want to get long at, right? We're filling in the details of this directional bias. Only after we fill in the details and understand what we think the market is going to do, right? What side of the market we want to be on, what is the price location, the zone in which we want to be involved. Only after that does the reason for entry become important. Because think about it the other way, right? What if we started with reason for entry and didn't make any predictions, right? So we're starting by looking at the thing, right? Whether it's, and we'll go into the charts and I'll give some examples today, but whether it's a double bottom, right? If we're just looking for double bottoms, right? How successful are you going to be only looking for double bottoms, right? Not successful at all, right? There are double bottoms and double tops all over the place. I can tell you from personal experience, right? Because I did this when I first tried to shortcut my trading career. If you try to trade every single double bottom and double top, you are going to lose a lot of money very, very quickly, right? Akil had that lesson, so you don't have to go through it. And what I learned during that lesson is that although it is a good, simple pattern formation, it's only relevant if it's in alignment with my underlying prediction of what I think is going to happen in the market. Again, I tell my traders this, right? Why would you ever buy if you don't actually think that price is going to go up? Why would you ever sell if you don't actually think that price is going to go down? And by think, of course, I mean the thinking comes from not our emotions, but from our analysis in the market. So both are important, but that entry doesn't come into play until after you make the prediction. The last thing I want to mention with the entry as well is that the entry, one of the reasons it's less important, because there is no such thing as a magic entry. An entry is all about personal preference. Now, you need a reason for entry. You need something rules-based to keep you kind of centered, to keep you under control, to keep you from just going out there and recklessly gambling. But there are so many options that you can choose, right? If you're super aggressive, you can just put a limit order or a stop order in a specific zone, and that will get you involved. If you're super conservative, you can do a 26-18 where you need basically like a three-part test, a three-part hold to really tell you that price is likely to reverse. And of course, there's everything in the middle, right? So there's various entries that you can use, and there's so many options there that the magic entry just isn't as important. It really ends up being what is your personal preference, and that's based off your personality and philosophy about the market. So I'd love to have this debate. You can leave a comment in the comment section below if you want to share your opinion. Again, this is just mine. I'm not here to say someone's right, someone's wrong, but if you do have a difference of opinion, make your case. Make your case. I do think I'm right on this, but I'm always open to hearing. So what we're going to do now is we're going to hop into the chart. I'm going to show you some examples of making predictions and using the entry secondary, and maybe I'll try to find the example of trying to looking for the entry first and not making prediction and compare the two. Now, before we get into it, two things I want to remind you of. First and foremost, hit that like button, subscribe if you're new, support the channel. It's the best way you can do so. Do these free videos for I don't know how many years, and the least you can do is just hit that like button, show me some love. Also, I mentioned the free workshop that we did for the last 2 weeks. Well, we got a few emails, a few people were out of town, a few people didn't have a chance to finish up. So what we're going to do is we're going to have all the recordings available until April 30th. So if you missed any part of it, or you just want to review, or you just want to play around with the software that we gave you, April 30th is when everything is gone. Sign up. I'll put a link below, but you can go to www.tier1trading.com. Sign up for Emergence. You'll get access. Go through the 2 weeks of content. Become a better trader. And do it all before April 30th, because I don't want to get emails saying, Akil, I missed it. Can you hold it on longer? The answer is no. All right. Let's hop into the charts. Let's look at some examples of predictions versus entries. All right, so let's take a look at the charts. We're going to look at an example, I guess two examples of trading opportunities. One where we're doing analysis first and making a directional prediction, and another one where we're kind of just using the entry reason to try to predict or to try to take a look at what we're going to trade. I may throw in a bonus pair as well because there's another one that I want to follow up on, but we'll start here on the Euro-Aussie, and we're on the daily chart, and the daily chart is where I like to start my process. Again, that process is IPDE, identify, predict, decide, execute. I personally like to start on a higher time frame, get a lay of the land, make a directional prediction, make a more specific prediction on where I think price is going to go to if we do continue in that direction. And then I like to dial down to my lower time frames to look for the specifics. So here on the Euro-Aussie daily chart, we've been in a bearish trend. This has been a pair we've looked at a lot over the last few months here in the Trading Edge video and obviously in the live room over at Tier 1 Trading. But we've been in a bearish move lately, and we are still in that bearish move, right? If we kind of go to the basics of reading the ebbs and flows, we can look at the bigger picture right here of creating a new structure low. And even though we're starting to lose momentum, right, we have continued to create new structure lows right here after the double bottom. And we are now retesting the previous outside return, a previous level of structure. So this becomes a level that I'm interested in because this level of structure resistance should be a pretty important holding point in the market, right? This was kind of the last bullish spike before the bears pushed it down. If the bears are going to continue to be interested in this level, they should try to protect this. So I have a bearish bias for this trade. We're in a location where I'm looking to get bearish. We can now dial down to our lower time frame. So if we go down to, let's go down to a 240 chart. You should see one of our VS1 levels pop up. Yep, you're going to see one of our VS1 levels pop up right here. This is that red box again, signifying levels of support and resistance, and price is right at it. So let's say I'm someone that is looking to get short, right? I have my directional bias. I'm looking to get short. My reason for entry is a double top. This is a perfect place where a double top would make sense, right? Because the double top is a simple pattern formation where we would look for a sell. So price would test a level initially. We get a little bit of a retracement off of that. We put in a secondary test. The secondary test would hold as well, sometimes shaking the rest of the buyers out of the market if we probe past the structure level a little bit. And then we would expect a move back down. Now, some of you are looking at this. Yes, there is an advanced pattern here as well, so we can actually add to this case if we were making this a CTS trade. I think we talked about that in last week's video, 2 weeks video. I'm a little bit confused. The event has me kind of thrown off of what we've been doing here on the trading edge, but we certainly talked about CTS trading in the past here on the YouTube channel and of course in last week's event. But we also have this happening as well. We have an X to A to B, B to C, C to D completing right up here, which is an advanced pattern formation as well. So we have another thing that we can add to our list, giving us clues that this may be a good place to sell. But sticking to the topic, which I always find a hard time doing, the point is, right, we did our analysis on the higher time frame. We identified that we were looking to sell here. We then went to our reason for entry, which was the double top, and our reason for entry complemented our analysis from the higher time frame. Now, if we look at a different scenario, let's say price action, I'll erase all this for you. Let's say price action wasn't trading at this level. Let's say price action was trading right here in the middle, right? So you have important level of structure up here. You've got important level of structure right here. In the middle, you don't really have too much, right? So let's say a trader didn't do the top down analysis. Let's say the trader was only looking at this and we saw a double top right here, right? Not saying that this is a poor selling decision, right? Obviously, you can do whatever you want. Hopefully, you've developed a plan. That plan is testable, verifiable, and repeatable, and you've tested it to ensure that it is profitable. But we know that many traders don't do that. Many traders just read about something or see something on the internet, and then they go about and trade it. So the question is, what if we get a double top right here? Is this a potential sell? And again, of course, it could be a sell, but is it the best place to sell? And as professional traders, we're not just looking for buying and selling opportunities. We're not just looking for action in the market. We are looking for the best trades, and that's going to be quantified differently by each person. But for me, the best trade is when the what lines up with the where. So looking at this location right here, because we're in the middle of no man's land, I'm a structure trader, so I need relevant levels of structure. That's where I personally like to take trades. So for me, we are not at a relevant level of structure. We are above one, we are below one, but we are not at one. So just because we have a double top here, right, doesn't give me any type of reason to sell, right? This double top for me can simply just be the market. Oops, sorry about that, sticky buttons. This double top for me can simply be the market giving us a little bit of relief, right? And then starting the extension to the next level. So again, we look at two things. In one scenario, we have the entry reason, which is the double top, where it's much better when it aligns with your overall prediction, not as good when it's just in the middle of no man's land. Because again, if you're not actually predicting that price is likely to go short here, what is the point of taking a short? It just, it may seem simplified. For me, it just seems like basic common sense, right? Don't trade something if you don't think the price is actually going to go in that direction that is needed to make you profit. But we're all a little bit different. So hopefully that example cleared things up. Again, a little bit rushed. I do want to go back to one more pair. And again, I'm doing this early in the morning. I got to head out soon, so I want to get this in. So apologize for the rushness. But pound yen, right? This is a pair we looked at the beginning of last week, right? If you guys were at the event, or if you plan on signing up for the event to watch the recordings, go to the day 2 session, I believe, the New York Live Room day 2 session. We made a very nice prediction on pound yen breaking out of this previous level of structure up to about 168 and further. Now I say further because there's still room for this to go, right? That 168 was kind of our conservative target point, but we think we can push all the way up to about 174s here. So there's still a lot of meat on the bone. And what we've had here is a lot of relief. Now I haven't done my debriefing of the week, but we saw a lot of movement at the end of the week, and it was on pound pairs, it was on some dollar pairs, it was interesting, a Freaky Friday, as I would call it. I don't know what caused it yet. I know we did have some monetary policy some monetary policy talk come out on Friday, which is what I'm assuming caused it, but I'll go check my sources and kind of understand what happened later. But the point is, I don't really care what happened from a fundamental perspective. I care very little. I care a little bit, not a lot. From a technical perspective is what matters most for me. And you can see that price has given us, after an extension up of a couple hundred pips, we've retraced right back to our initial breakout point. This is going to offer another opportunity. So again, when I look at my bias in the market, I still have a bullish bias, bullish bias, bullish bias. So I'm only looking for bullish opportunities. We go down to our lower time frame once again. And just like the Euro-Aussie, but in a slightly different way, we have an advanced pattern formation here. And again, this is going to be another good example of how your analysis can help you. We had a bearish bat before, we have a bullish bat now. So we know that a bullish bat, it's a buying opportunity. Something you can do with this trading opportunity, if you want to get a little bit more of it off of it, you can combine it with your overall analysis. Typically with a bat pattern, we're only looking for a short move, right? We're looking for a move. You can see the levels right here from our entry point right down here up to our target 1 area if you're a target 2 taker, up to your target 2 area for secondary targets, right? Solid move, right? 130 pips to target 1, 200 pips to target 2, right? Not bad. But because you've done your analysis, because you still have that overall bullish bias, you know the direction, you can identify the direction of the market, you can predict if that direction is likely to continue. This is setting up for one of those home run trading opportunities, right? It still is. Again, we had it before last week. It was a very good trade. Didn't follow through with all of the home runness to it, but gave us a good amount. This is a chance to reload, right? The market pulls back. It gives us a little bit of relief, gives us another opportunity to try and get involved. So not saying you should take everything and hold it for 174s, right? But you should at least, my opinion would be to at least leave a partial on. So maybe take a partial off at target 1, maybe even take a partial off at target 2, but leave some on for that potential extension because you have a bullish entry reason that lines up with a bullish prediction. When you can put 2 and 2 together like that, it's much more powerful than just having one without the other.